If you're not familiar with the term dividend yield, today we're going to talk about what is a dividend yield and how it's calculated. Let's first define what is a dividend. When a company earns money at the end of the year, it has to decide what it's going to do with that money. It could either reinvest the money back into the business, or it could pay it back to its owners, its shareholders, or it could do a combination of the two. It could keep a portion of it to invest in the business, and it could pay a portion out to its shareholders. That payment that it makes to its shareholders is known as a dividend. So while real estate is better known for generating passive income, dividends are also an excellent way of generating passive income, because the dividend stocks that you own are never going to call you in the middle of the night with a broken toilet or a leaky roof or anything like that. Dividend stocks are just going to continue to pay you regardless. So why do companies pay dividends? As I mentioned earlier, dividends are paid when a company decides to not reinvest that money back into the business and pay it back to its shareholders. Well, as I said earlier, when a company makes a profit, it has to make a decision. Are we going to take that profit and reinvest it in the company and grow it at a faster rate? Or have we reached a point of saturation where we don't have any more growth opportunities and we need to pay that money back to shareholders? For example, Coca-Cola is a great example of this. Coca-Cola is everywhere in the world. Coca-Cola pays a healthy dividend, but Coca-Cola, every time it earns a profit, it takes a portion of that profit, reinvests it back into the business for general business investment, but it can't reinvest all that money back into business because there's just no more places that Coca-Cola can grow, and it decides that it wants to give that money back to shareholders for them to reinvest it. Now, let's take another company like Facebook or Meta. Meta, when it earns a profit, it has a lot more growth opportunities. It has more avenues for it to take that money and put it back into use versus giving it back to shareholders. And as a shareholder, you may want a company to reinvest that profit back into its business, because as a shareholder, you may say, well, if you give that money back to me, I'm going to have to either put it in my savings account or buy or find another stock to invest in. I'd rather have that company take that money, reinvest it back in the business and grow it at a faster rate than if the money were to come to me. Also, if the dividend is paid out to you, it's a taxable event, whereas if the company retains the profit, it's not a taxable event for you. The only time you'd pay tax on that is if you were to sell the stock. So there are actually two great examples of this. Several years ago, both Microsoft and Apple at different times had billions of dollars on their balance sheet that were just sitting there in cash. And investors said, you either have to do something with that cash, reinvest it in the business, grow the business somehow with that money, or give it back to us, because by it sitting on the balance sheet of the company, by it sitting on the company's books, it's not earning anything. So both Microsoft and Apple at that time, again at different times, not the same year, both Microsoft and Apple paid a special dividend of that cash to give it back to shareholders as an example of showing to shareholders, we can't reinvest this money to continue to grow it, and we have so much cash, we're going to give it back. Now, obviously that year, the dividend yield on both those stocks was very high, but investors recognized that the dividend yield was high strictly because there was that special dividend that was paid by both Microsoft and Apple. So different types of companies pay dividends. So usually more established, value-oriented companies are more likely to pay dividends. So utility companies, consumer durables, I use Coca-Cola as an example, General Motors, Ford. More established companies tend to pay dividends because they don't have more opportunities to invest that profit than a more growth-oriented company. So usually technology companies don't pay dividends because technology companies are growing so quickly, they need all that profit that they're generating to reinvest back into new avenues of business and new growth opportunities. There are different types of dividends. There's either a cash dividend, a stock dividend. We're only going to focus on the cash dividend in this video. So a dividend yield, now that we know what a dividend is a financial ratio to help you calculate your rate of return on an investment in a company. Now, most people rely on the growth, the capital appreciation of a stock, which is if you buy a stock for $100 and it grows to $120, that $20 growth is capital appreciation. But investors must also recognize that in addition to capital appreciation, a company that pays a dividend has also a dividend income as well. So you have to factor in that $20 you would earn in that example of a stock growing from 100 to 120, plus any dividends you earn on that income. That is also a form of return on your investment. The dividend yield is calculated by taking the dividend that's paid by a company and then dividing it by the stock price. So for example, if Ford stock is paying $1 a share in dividends per year, and the price of Ford stock is $25, if you divide 1 by 25, you're going to get 4%. So 4% is the dividend yield for Ford Motor Company. It's actually not the dividend yield right now. I'm just using it as an example. But if you were to take the dividend that's paid by the company and you divide it by the price, that is the dividend yield for the company. It's important to note that the dividend yield changes if the stock price changes and if the actual dividend changes. So for example, if the dividend remains at $1 at Ford Motor Company, and the price of Ford goes up from 25 to 30 or 40, then the dividend yield is going to go down because the denominator, which is the price of that stock, is going up, which is causing the dividend yield to go down. Now, conversely, if the dividend were to stay the same at $1 a share, but the price of the stock went down, then the dividend yield will go up. Also, if the dividend itself were to get cut, then that too will change the ratio as well. In general, you want your stock price to increase as well as your dividend to increase over time at a healthy rate. That's what is representative of a healthy company. What you don't want is a stock price to go down while the dividend is remaining the same. That's not a sign of a healthy company. So that leads us to our next point is if you see a high yielding dividend, does that mean that it's a good company? And the answer is no. Most likely, if a company is a very high dividend paying company, that means that it's been paying a dividend for a while, and now the stock price has been slowly going down for a variety of reasons. Maybe they're having financial difficulty, maybe something's going on with the company, the profits are declining, but they have yet to cut their dividend. In that scenario, the dividend yield is going to look like it's artificially high, but the reality is at some point that company is going to cut their dividend because they're just not going to be able to afford paying that high dividend because their company's not doing well. So bottom line is if you see a dividend yield that's very high because the dividend itself is high and the stock price is declining, that should warrant you to dig a little deeper and find out why is the stock price declining and is my dividend that I'm going to get paid at risk of either being cut or being reduced. A good rule of thumb is to look back at a company's historical dividend payment history and see if they've consistently paid dividends, if their cash flow has been healthy, if their stock price has been going up. Those are good signs of a healthy dividend paying stock or a dividend paying company. Also, if there's a stock split and the stock price goes down, that doesn't necessarily mean that financial conditions have worsened. To learn more about stock splits, look at the other video I did where I talk about what is a stock split and how does it affect your cost basis. So in closing, a dividend yield again is a financial ratio to gauge your performance, your rate of return on a stock, and it's calculated by taking the total dividend that's paid divided by the price of that stock at any given point. And if the price of the stock goes up and the dividend stays the same, your yield goes down. If the price of the stock goes down and the dividend stays the same, then your yield goes up. Hey, if you like this video, please remember to subscribe, like, and share our channel. That's how we're able to create more content like this and help us grow our channel as well. Thank you for joining me for another edition of the ACAP Recap, where we go behind the blog and talk about questions that we receive directly from you about topics that you want to hear about.